You own gold because you think in the wrong, not the right, in the wrong set of circumstances, gold isn't going to go up by $100. It isn't going to go up by $200. It's going to go up by thousands of dollars.
Welcome to a captivating discussion with Rick Rule, where we unravel the mysteries of global currencies and gold's role in them. Can gold truly support the financial needs of nations? Will the BRICS nations unite under a common currency, or is it just a whimsical dream? As we venture into the realm of geopolitics and trust, discover the fascinating concept of a gold-backed settlement system between China and Russia. Buckle up for a journey into the curious world of international finance and diplomacy.
Mike, you said so many important things there. The first is that liquidity, almost irrespective of who you are, is important because if you get cash short, you are forced to do things that you otherwise wouldn't want to do.
Right.
The second point that you made, perhaps without realizing it, is that if you regard your gold and silver as mediums of exchange that are simultaneously stores of value, you can consider them liquidity if you are willing to sell them if a better opportunity comes up. Too many people, Mike, that are in our community refuse to sell their gold and silver when the price is down, when the price of other things is down more. I have many bad habits. I won't enumerate them, but one bad habit that I don't have is an unwillingness to sell. There are periods of time when I need my gold and silver as liquidity. That's why I own them. For me in particular, gold isn't a speculation. For me, gold is insurance and frankly, wealth. If there are other things that I can use the liquidity represented by gold to increase my overall wealth, I'm willing to do it. The same thing, frankly, with silver. I regard silver personally as a speculation. I regard it differently than I regard my gold. And I am eminently willing, personally, to use my silver for liquidity if, on a temporary basis, a more attractive opportunity comes along. The real yield on your treasury is -2. That's not particularly attractive to the Koreans and the Chinese and the Saudis. And if you put on top of that the weaponization of the U.S. dollar, the fact that if the U.S. government doesn't approve of your policies, they can default. They can cancel on the debt you hold. And if you weaponize it, like we did through the SWIFT banking system, the extraterritorial imposition of U.S. values on the rest of the world guarantees the slow motion decline of the U.S. dollar as the reserves currency. The BRIC currency, I think, is a misnomer. It will not be a currency. There isn't enough gold on the planet, almost irrespective of the price you put on gold, to backstop all of the domestic transactions in a group of countries whose GDP is larger than the G7's.
Yeah.
The idea that they're going to have a common currency and politically suborn their individual national interests to the common good of the BRICS is a silly, silly fantasy. However, a gold-backed settlement mechanism where the trade surplus that China enjoys, as an example, with Russia, could be settled outside the U.S. dollar system in gold, I think is a very interesting concept. I actually don't think it's going to occur because I think as little as the Russians and the Chinese trust us, they trust each other even less. I could see a circumstance where Xi went to Moscow and said, you guys owe us the equivalent of $10 billion in gold, please settle up. And I could see Mr. Putin saying to them, well, here's 100,000 bricks. And I don't mean gold bricks. I mean settlement bricks. If we have the liquidity crisis that you expect, I suspect that capital markets will respond the same way they responded in 1987 and 2008, which is to say everything will sell off. The policy response to that will likely be money printing on a scale that we've never seen before, which is to say economic margin generated in the United States. At some point in time, you push on the string, and there's no push left. And so not the nervousness, I think if we do have a liquidity crisis, irrespective of the source, the policy response will be the same as the policy response before. The difficulty is that the negative impacts of negative real interest rates and quantitative easing and debt and deficits are cumulative and compounding, which is to say that we're pushing liquidity in the system, or we would be pushing liquidity in the system the same way that we did in 1987, the same way that we did in 2008, but the system has many more encumbrances, many more imbalances than it had then. So that the response to the policy, I think, will be less dramatic on the good side and more dramatic on the bad side. Now, let's return to silver. Let's get away from macro. Let's talk about silver. My experience with silver, and I'm not sure why, is that silver is a late cycle mover, which is to say, in precious metals bull market, the trend is established by gold. In the middle of the up move, silver begins to move. It moves faster then and much further than gold did. I assume that's because of silver's low unit price, which is to say, when the bull market democratizes and people with less means want to participate, the easiest and best way for them to participate is in silver. I'm making this up, by the way, Mike. I don't know why this is true, particularly in South Asia, where there's a cultural predisposition to precious metals. At one point in time in my career, frequented the United Arab Emirates a lot. And there were a lot of Indian and Pakistani guest workers there. And you could go to the gold souk, and what you would see is that South Asian people would save in precious metals. And which precious metals they chose was really a consequence of their economic circumstance. Many of the labor force wasn't able to save in gold, so they would save in silver. And I think one of the things that you see in precious metals bull markets is that when the narrative is established, not just in the United States, but internationally, that silver becomes the savings instrument for the poorest half of humanity. And their individual impact is, of course, less dramatic than the impact of the average American. The sheer numbers and the cultural predisposition in countries like India, Pakistan, Bangladesh, Sri Lanka, China, Korea, the centuries-long familiarity with precious metals often means that in circumstances where confidence is called into question, that the unit value of silver makes it the preferred savings instrument. Let's make a very different case for gold that doesn't require the collapse of humankind. In the first instance, the situation doesn't need to collapse so much as deteriorate, which I think it will. I point out every time I have the opportunity that the market share that gold and silver enjoys as a percentage of total savings and investment assets in the biggest investment market in the world, which is the United States, is only 0.5%, which is to say 0.5% of the total value of savings and investment assets in the United States. Not worth much. The 4-decade mean market share for precious metals in the United States was 2%. So if debt and deficits and all of the difficulties that you describe begin to play on the American psyche, not to the point in time that they cause panic, but rather to the point that we simply revert to mean, demand for precious metals related investments increases fourfold. And that's my base case. Now, you make a separate point, and that point is a very different point, and it is dramatic. Please don't make it show up in the headline for this interview. But although there were no reliable statistics at the time, JP Morgan Chase believes that the market share of precious metals and precious metals related assets relative to other savings and investment assets in the United States in 1981 was between 6 and 8%. You said, I think there's two important things there. The first is that the case for owning physical gold and silver, or if you're an investor or speculator, gold and or silver stocks, is ironclad. It doesn't need to require the collapse of the institutions of humankind. It only requires reversion to mean. The second point that you made is, I think, maybe more profound for the listeners. So many people who listen to these interviews, Mike, are long gold and silver for the wrong duration, which is to say the short term, and for the wrong purposes. And many of them slavishly look at the near-term movements in the gold price. The gold goes from 1935 to 1955. and these people feel vindicated. If it moves from 1975 down to 1925, they fall into despair. You own gold because you think in the wrong, not the right, in the wrong set of circumstances, gold isn't going to go up by $100. It isn't going to go up by $200. It's going to go up by thousands of dollars.
Yes.
You own it, frankly, hoping, perhaps if you're Christian, praying that you're wrong. But you aren't owning it for $100 moves. You're owning it for $1,000 or $2,000 moves. If you look back 3 years, in the year 2000, when gold, frankly, was a four-letter word that nobody could spell, the gold price had increased to $1,850 an ounce. So people who are looking at the stuff with regards to a $100 move are missing the point.
Thank you for tuning in to this insightful discussion with Rick Rule. We hope you enjoyed exploring the possibilities and complexities of gold in the global financial landscape. Don't forget to like, share, and subscribe for more engaging content on finance, geopolitics, and beyond. Stay curious, and we'll see you in the next video.